Okay, well, let's see how this applies to some of your top ideas. Let's get into pro picks. Pro Picks is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. So all your pro picks, Gordon, have a theme. They are all financials, U.S. financials. And before we get into them, maybe talk to me about this sector and why it's so exciting, because this is a big week for U.S. financials. They're all going to start to report their results. And I would say if it wasn't for tariffs, we would think everything's great. There's no credit quality issues. You know, investment banking is starting to come back, but it's not going bananas. But then, you know, there is that anxiety about tariffs and interest rates. Right.
So I picked the theme because I think this is one industry that really hasn't participated in the last couple of years of market performance. These are companies that, if you go back to the great financial crisis of 2008, have had to sort of recapture their credibility. Like a lot of companies, they're going to take advantage of whatever they can, cut corners, and there's probably more risk there than meets the eye. And the same was true in 2008 when, of course, the banks got caught and, you know, it was pretty bad.
Yeah.
So what happened was the regulators put their foot down and through worldwide regulation mandated that these banks increase their capital levels and pass yearly stress tests that test a scenario of Armageddon, like terrible. And that's led to these companies, this industry, being the best capitalized they have been in their history. So where we are now in 2025 is that we've got an administration in Washington that is saying we're overregulated, we've got to pare back, we've got to release some of this capital, and it will become more productive for these banks. These banks are trading at historically, I won't say inexpensive, but not demanding multiples. So, you know, the big major money center banks are trading somewhere between 13 and 15 times earnings. They're trading at anywhere from 1.25, 1.3 to 2.2 times book. So, you know, reasonable, but they've got a huge runway ahead of them. What's happening? Well, we're in a very active environment economically. You know, people are worried, but people are always worried. If you look at it, we've got good employment numbers. We've got an inflationary environment that is cooling off the COVID experience. And I would think that given what I've said about AI, that there's deflationary aspects that are right ahead of us, which is going to allow corporations to expand margins, which will boost the ability to grow multiples. You've got interest rates which are fairly low historically and poised to fall lower. Well, why are they poised to fall lower? Because almost everybody who has any power wants them to go lower, starting with the President of the United States. And you have to remember, even though if you say the Fed is independent, the president is the one who decides who's going to be Fed chair. And
so you don't get fussed if it's July, October. You just know directionally this is where it's going.
Absolutely. Now, it's going to go lower. Sorry, I keep talking, but it's going to go lower. Interest rates are going to go lower. But monetary authorities really only control the short end of the curve. The long end of the curve is controlled by economic forces and the bond market, the bond kings. So what is likely to happen if short interest rates are forced lower artificially, that is by people who just have an interest in them being lower, you're going to get a sharper and a steeper yield curve.
Which is good for the banks.
Which is good for the banks.
Because they lend long, borrow short. So their interest rates will be lower, but then they make more on the back end.
Make money the good old-fashioned way.
Okay, let's see how we apply this in the portfolio. Your first idea is Goldman Sachs, which reports this week. It's had a huge run. sitting near records. Let's talk valuation. Let's talk catalysts. Why do you see it going even higher?
65% of their business is capital markets business, so investment management. What we've seen thus far is that the great capital markets boom that everybody was predicting has been delayed. It's been deferred. Why? Because everybody's afraid of tariffs, and nobody in the boardroom wants to pull the trigger because they just don't know what tomorrow will bring. What we've seen is a lot of deal flow, but big deal flow, so $1 billion plus, but smaller companies aren't acting. They just can't afford to be wrong, but that will come. Once there's more stability, once the visibility is there, the capital market cycle, we believe will be very, very strong, which is great for Goldman Sachs. That's the bulk of their business.
And the breakout happened after kind of years of meandering, right? And languishing for the stock. It finally got its mojo back under its current CEO, David Solomon. And remember, there were some anxieties around David Solomon and whether he was the man for the job. Did you ride the stock out through all of this? Has this been a long-term hold for you guys?
No, we bought it a few months ago.
Okay, so it's new.
It's new, and we've done very, very well with it. Boy, Amber, I don't have it right on the top of my head, but I would say we probably bought it somewhere in the low fours.
400s?
Yeah.
Oh my goodness. Maybe a little higher because the low in April was like around let's call it 460. Okay. Goldman. Yeah, so now you're up like 52% in that. You don't get scared by those big gains in a short period of time?
You love big gains, but if the fortunes of the company have kept pace, you're okay. There's an understanding that as the price of anything rises, its value tends to drop, but that's not always true. If you have a stock that rises 50%, but its earnings rise 60%, it's a better value at the higher number than it was at the lower number. But I wouldn't say that's the case with Goldman Sachs. I would say that the valuations are less friendly today than they were when we bought them, but not meaningfully so.
Okay, and talk to me about Morgan Stanley, which is your second idea. Does it benefit from all of those tailwinds as well? Is there something extra special about Morgan Stanley or different?
Well, a little bit different. They do benefit from capital markets business, but unlike Goldman, where 65% of Goldman's revenue come from capital markets business, about 35% of Morgan Stanley's comes from that area. They've built a wealth management shop. They started that, Morgan Stanley was always known as sort of a fixed income specialist, large institutional manager. And they flipped that right around, starting back about 15 years ago with the deal with Citi. They took on Smith Barney, and they've added E-Trade, Eaton Vance, to the point now where they have about $5 trillion under their wealth management umbrella.
Which gives them more stable, less volatile access to income. That's
correct. And it also leads to slightly more demanding valuations. So they trade at a little bit more of a multiple level. I think Goldman's at around 15. I think Morgan's at around 16. Goldman's at somewhere around 2 times book. Morgan Stanley somewhere around 2.3. So, but one would expect that. A new CEO at Morgan Stanley, and Ted Pick, who's been there for many, many years, but has just.
And is this a new buy for you too, or you've owned it?
No, we've owned this for a number of years.
How did you think about, or did you think about the CEO change? Because I think, when you've had like James Gorman, who's a former CEO, who's been there for 13 years, right? Becomes synonymous with those changes at the bank, helping it rebuild after the financial crisis. And then you put in someone new, even if he's been with the bank, that is a transition to manage. I remember there being anxieties around it.
Yes, and James Gorman was no shrinking violet. It was his way or the highway, and given that Ted Pick worked for him and survived, he was a disciple of Gorman's. You had to think that the playbook was going to be carry on, and that's exactly what we've seen.
Your third pick, less of a household name, not trading as well, but maybe that's where the opportunity is. Jackson Financial.
Yeah.
I know less about this one, and it's a smaller cap, $6.2 billion.
Right. Well, at Goodreid, we have two U.S. mandates, one a large cap, one a small cap. And, it's a different world. We've run both for decades. The large cap started in 1986 and the small cap in 1992. So very, very long track records. But we populate the small cap with more names because we've got more company-specific risk in smaller names. So we offset that with more names. So offsetting non-systematic risk with systematic safety, if you want to put it that way. Jackson Financial is one of those. It's an interesting company. They sell annuities. And annuities is a word that I think a lot of people know, but maybe they don't know exactly what an annuity is. Well, it's a stream of income that's guaranteed for the life of the individual. So you buy it, and then actuarially, they figure out how old you are and what capital you have, and they say, okay, with this much money, we will pay you this amount each month until you die.
Yeah.
There are variations off annuities. There are variable annuities. There are some risk-adjusted annuities now that anticipate or build in an underlying asset direction. So they might be based off the equity markets, for example, and you'll get a different answer than if you just invest in an interest-bearing vehicle. So Jackson has this business. They do about $8 billion a year, a $300 billion AUM book. The thing that attracted us was the fact that the management are all actuarially trained. They're very good at what they do. They're not always successful in all environments. They do better with a steeper yield curve, which we think we're headed towards.
That's right.
And they pay out a lot of their capital to their shareholders. For this year, they're projecting, I believe, $700 million of dividends and capital return to shareholders. And if you do the calculation, that represents 12% of their entire market cap.
Wow.
So they're a cash machine. They trade at 4.5 times earnings. Yeah,
Let's say that again.
Yeah.
Not book.
No.
4.5 times earnings, throwing $700 million back at shareholders.
Correct.
For a $6.2 billion company.
Yeah, and it's 0.6 times book value. The risk, of course, there's always the other side.
Yeah.
There's a reason for everything, is that if the environment doesn't work for them, they're going to go dormant for a period of time. But that's happened before. They're used to that. We think that they're set up with a backdrop that will lead to success.
Love these under the radar. One under the radar pick. The other two, we can at least have some comfort in Goldman and Morgan Stanley. Gordon, it's been an absolute pleasure. Thank you so much for joining me on the show.